Hello, today we're going to be going over Target's Q2 earnings. Their ticker symbol is TGT. Some things to highlight here is that their income margin was up 4.8%. That's really good compared to last year. One thing they did do was decline their revenue sales, but that was to be expected. We expect them to continue to decline for the next few quarters going forward due to the fact that the economy is really bad and more people are going to be shopping at places like Walmart, Costco, Amazon, stuff like that, where it's cheaper for them, more affordable. Target likes to sell a lot of things that aren't primary goods that are important for families, essentials, and groceries. They have a significant amount less of grocery sales compared to a place like Walmart, so that's another thing that's going to affect them. One of the reasons why their profit margin was higher, though, was because they had 17% less inventory. So that is good that they don't have as much inventory on hand. So that really helped with their profit margins. But they did decline their overall EPS down to between 7 and 8. Originally, the lowest they were projecting was 7.57, so they have lowered that significantly. As you can go down here, though, as you scroll on down, you can find their webcast details. You can find right here, and then you can watch that. Something about Target, though, is that they're going to continue to increase their free cash flow because they're a free cash flow machine, and that's something that I really like about them. They pay really good dividends. Compared to last year from now, they have a 20% increase in dividend payments. That's simply because, one, they increased their dividends, and two, cost per share basis of the shares. But yeah, so this is their quick little overview. Some things that I just highlighted real quickly before we get into creating a valuation for Target based upon their most recent Q2 earnings. But if you do go back here on their press release, you can go to the article. If you go to the article, you can see here. Yes, you can click full results. This is what I typically like to use. But as you can see here, it just highlights the main concerns. And look, negative 10.5% digital sales, negative 4.3% stores, and then overall negative 5% year over year. It's showing, though, this is one of the things that they were investing in, because Target was investing heavily into their infrastructure, their online business, and their warehouses, try to compete with same day shipping with like Amazon and Walmart. As you can see here, though, they saw same day growth, 4%. So that's really good, so that is increasing. They already were expected to be hurting on back to school sales this year, so I'm wondering how much of that was a factor, and I haven't looked into that yet. But their long-term growth and profitability, we're on track to invest $4 billion to $5 billion in the business this year through new and remodel stores, supply chain, and digital capabilities. So 11 of the 20 new stores planned in 2023 are now open. 51 of the 175 stores are undergoing remodels or other enhancements. And then they brought another shortage center to Miami. So this is some of the things that they highlight here. You can just look at these quick things as opposed to I'm sorry, I already had that article up. Okay, so for some reason I don't have it up right now. I'll have to show it to you later. Thing I did want to highlight in their other press release was that their dividends and reinvestments, they still have over $9.1 billion to buy back for dividend reinvestment. Not dividend, but buybacks for the program. So $9.1 billion that was approved in 2021 is still available for them to buy back of Target. So they are going to decrease shares when the time comes, and they have that money allocated already, but they don't want to do that right now because they're investing heavily into the things that I just mentioned that they were highlighting. And then also the economy is getting really bad, so they're going to want to keep that cash on hand. They did have a lot of cash on hand this quarter, so that's good. I just want to click on shares outstanding here after going to revenue and come on down. As you can see, it's been decreasing. So look, 2021, 729, 684, 663. So it's just steadily decreasing, and we're down to 464. So that is a ton difference. That's over a 10-year period. We'll just show you over a 10-year period what that's done to the calculations. So if you come on over to here and Target, right here I already did the math. So we're going to use this which is $3,840,000,000 for the free cash flow. just based upon the last quarter results. Their free cash flow for the quarter was 960. What was it? 960. Yeah, 960 million for the quarter. So that's really good. That's about their average for free cash flow. Their growth rate. So it depends how you. We're not going to use 11% growth rate for Target because obviously we know over the next 10 years they're not going to grow at 11%, especially considering we're going to be at a negative forward growth rate going forward. So if you come over here, if you want to, if you like to use it this way, see their revenue growth that they're doing 1%. Yeah, so that's something they're doing because going forward for the next years we're going to be really low. So that's why they forward. But as you can see, EPS forward long-term growth 9%. So yeah, but what I was looking at, a few other things, and Target, just for even like a 5-year span, I think an average growth rate about 3% right now is what I was coming up with, what I was looking forward to. So as you can see here with the 3% growth rate, based upon that average cash flow from this quarter, which is not usual to their usual cash flow. What is the outstanding shares? 465 or 463. It just showed. So it would bring us to $113.60 for the price with that 10% discount rate. With an 8% discount rate, it would bring us to $152.26, and then 10% discount rate of that, $137, $121. But we want to grow 10% year over year, so we're going to use this. This is based upon if we were to use a 3% growth rate. Now, if we were going to use what analysts think something different. Yahoo Finance, you can see what they feel like it's going to grow like over the next 5 years. I'm very conservative. Nobody knows what the growth rate is going to be. You can only go by historical averages and what the economy and what their business looks like. See, they're just like Seeking Alpha, that 9%. That 9%. So they think they're going to grow 9% the next 5 years. The last 5 years they were growing on average 7%. Okay, so let's just go ahead and use the 7%. If they were to keep continuing to grow at 7%, you see what it does here? 151, 10% discount, 136. Base price, that's a 20% discount, 121. That's what we're doing here. But now, look what the prices would be if it was 684 without the buybacks. 145. So it makes a big difference with the buybacks. We're going to come over here to the dividend discount model. And then, as you can see here with the 6.5% growth rate, 10% discount rate, we're going to get a dividend price per share of $133.89. And here's the 10% discount rate, 15%, and then 20%. This is for Target. So yeah, their average growth rate, as you can see here, for their for their 1 year is 22%, but the forward dividend per share 10.5%. This is through Seeking Alpha. They do grow more though, as you can see here, like over the 3 year 17%, 5 year 11%, and 10 year 11%. So it isn't out of the capabilities to grow at 6.5%, and the reason I do that is because recently, because like we've been saying, some of the economy things, they went from 1.08. So here we're going to take 1.10 minus 1.08. Oh, I'm sorry. It wasn't 1%, but 1.10 times 4 brings us to the 440. But 1.08 times 4 brings us to 4.32. So now we're going to take our real formula, equals, and then we're going to have 4.40 minus 4.32, and then you're going to divide that by 4.40. 4.40, close it off, and we got an error, so I messed up the formula somewhere. Let's see. It's closed off, it's closed off. It should not have messed up, but let me see. Error. Okay. Oh, that's why. Minus. So if you put that in percentage form, 1.82%. As you can see, that was a recent dividend increase, which was very low. So we're going to go ahead and bring us to 6.5% because I think their free cash flow is going to continue to be great going forward. As you can see here, their average free cash flow, their cash flow machine, since 2010, it's just been going up and up. And then 2021, it reached 7. 2022 5, and then they've been growing a lot this year, so the free cash flow is negative, but they just had a free cash flow positive quarter of 9 million. So yeah, I think Target is a buy, and I think a good price, discount rate, good price to buy Target based between our two valuations here would be about $125. Thank you.